Good morning. Good morning, everyone.
Morning, sir.
Yes, today we shall be looking at withholding tax. After withholding tax, we look at tax haven. After that, we are now going to look at tax evasion and avoidance. So this morning, we shall look at three major topics: withholding tax in Nigeria, tax evasion and avoidance, and tax haven. Those are the topics we are looking at this morning. What is withholding tax? What is withholding tax? Withholding tax is an advance payment of income tax. Withholding tax is an advance payment of income tax. And it is an anti-tax evasion and avoidance policy. It is an anti-tax evasion and avoidance policy. Withholding tax is used to discourage tax evasion, and it is used to discourage tax avoidance. So that is what withholding tax is really talking about. There are some income that attract withholding tax at source, that we are going to deduct withholding tax from those income at source in order to avoid the receiver of income not to pay tax. So that is why they introduced withholding tax. Withholding tax is not a type of tax. So, but it's a form, is part of an income tax. Income tax. Withholding tax is a part of income tax, either company income tax or personal income tax. It is used to discourage tax evasion. Some income earner, they will receive income. At the end of the day, they will not disclose such income to the government. In order for government not to collect tax on those income, that is the reason why some of the income earner don't disclose the income to government. So as a result of that, government now introduce an anti-tax evasion and avoidance policy, which is called withholding tax. That means if you receive an income at source, some specific income at source, they will deduct withholding tax. So as at present, we have withholding tax regulation 2024. Withholding tax does not have an act. Withholding tax can only have a regulation, because withholding tax is a form of income tax, company income tax, or personal income tax. So you cannot see withholding tax act. No, what you are going to see is withholding tax regulation. The current withholding tax regulation that we are using, effective from January 2025, is called Withholding Tax Regulation 2024. Withholding Tax Regulation 2024. That is the current withholding tax we are using. So this withholding tax regulation 2024 will start from January 2025. So that is the current withholding tax we are using. Now, administration of withholding tax. Administration of withholding tax. Administration of withholding tax. Who administer withholding tax? Withholding tax can be administered by Federal Inland Revenue Service if the receiver of such income is a company. If a company receive an income and withholding tax want to be deducted on that income, that withholding tax is going to be remitted to who? To Federal Inland Revenue Service. That withholding tax is going to be remitted to Federal Inland Revenue Service. Why for individual, sole proprietorship, partnership, and so on, the withholding tax of such income is going to be remitted to who? State Board of Internal Revenue Service. State Board of Internal Revenue Service. So please, let's try to mute our audio. Let's try to mute our audio. If you want to ask a question, please, Mr. Lusoji, mute your audio. But for the resident of FCT, for the resident of FCT, the withholding tax, please, Mr. Lusoji, you are disturbing us. Try to mute your audio. For the resident of FCT and member of Armed Force, Nigeria Police, their own withholding tax is going to be remitted to Federal Inland Revenue Service. However, as at present, for the resident of FCT, the withholding tax of resident of FCT cannot be remitted to Federal Inland Revenue Service again. It will be remitted to FCT Internal Revenue Service. While for non-resident individual or non-resident company, the withholding tax may be remitted to who? Federal Inland Revenue Service. For resident of for non-resident individual, those who are not resident in Nigeria or non-resident company, their own withholding tax is going to be remitted to who? Federal Inland Revenue Service. So that is the administration of withholding tax. What are the features of withholding tax? What are the features of withholding tax? One of the features of withholding tax is payment of withholding tax is statutory on the person making the payment. Payment of withholding tax is statutory on the persons making the payment. Payment of withholding tax is statutory on the persons making the payment. Payment of withholding tax is statutory on the person making the payment. Number 2 features of withholding tax is Number 2 features of withholding tax. Withholding tax credit note is usually used to offset tax liability. Is usually used to offset what? Tax liability. It is usually used to offset tax liability. Withholding tax credit note is usually used to offset tax liability. Another features of withholding tax is that withholding tax represent final tax on some of the income, like dividend. Their own income, their own withholding tax is a final tax. That means that withholding tax cannot be used to offset future tax liability. Withholding tax on dividend is a final tax and it cannot be used to offset tax liability. Withholding tax credit note on dividend is called dividend is a frank investment income. And when withholding tax is deducted on dividend, such withholding tax cannot be used to offset final tax liability. Unlike some other income, when you deduct withholding tax on interest, or deduct withholding tax on rent, or you withdraw withholding tax on professional service, at the end of the year, you can use such withholding tax to offset your final tax liability while you are computing your tax liability at the end of the year. So withholding tax is a form of credit. When they deduct tax as source, when you want to compute your final tax liability, you can use the withholding tax to offset your final tax liability. However, there are some income in which the withholding tax cannot be used to offset final tax liability. Such income is called frank investment income. So such income is called what? Frank investment income. Example of such income is called what? Dividend. So somebody raise hand. What is your question? What is your question?
Please, can you rewind? I just joined the class. Can you rewind from the beginning?
I should rewind from the beginning. Okay, I just started not quite long. The topic we want to do today, we like to do 3 topics. Number 1 of them is withholding tax management in Nigeria. Number 2 topic we are doing is called tax evasion and avoidance, while number 3 topic is called tax haven. So we started from withholding tax. We said withholding tax is an advance payment of what? Income tax. It is not a type of tax, but it is an advance payment of what? Income tax. And it is an anti-tax evasion. It is used to discourage tax evasion and avoidance. And we said withholding tax is normally deducted at income at source. And when the next thing we talk about is we talk about administration of withholding tax. We said who administer withholding tax? An income received by company, corporate organization, the withholding tax is going to be administered by Federal Inland Revenue Service. While income received by individual, sole proprietorship, partnership, the withholding tax is going to be remitted to who? State Internal Revenue Service. However, member of armed force, Nigeria Police, their own withholding tax is going to be remitted to Federal Inland Revenue Service. But the resident of FCT, their withholding tax is now remitted to FCT Internal Revenue Service. While non-resident company or individual, their own withholding tax is going to be remitted to who? Federal Inland Revenue Service. That is administration of withholding tax. After administration of withholding tax, we now talk about features of withholding tax. One of the features of withholding tax we have is payment of withholding tax is a statutory obligation. And I told you withholding tax does not have act, it has regulation. Because withholding tax is a form of company income tax or personal income tax. So the act that governs withholding tax is either Company Income Tax Act or Personal Income Tax Act. But there is a regulation. The recent regulation that we have on withholding tax is called Withholding Tax Regulation 2024, which is going to be effective from January 2025. The current withholding tax regulation we are using is called Withholding Tax Regulation 2024, which is going to be effective from January 2025. One of the features of withholding tax, payment of withholding tax is statutory. And we said another features of withholding tax credit is used to offset tax liability. This one means at the end of the year, that withholding tax deducted from your income when you receive such income, when you are computing your tax liability, either you are a company or you are individual, that withholding tax deducted on your income, you are going to use it to offset your final tax liability. If the receiver of income is a company, that withholding tax is going to use to reduce company income tax at the end of the year. If the receiver of income is an individual, the withholding tax is going to use to reduce personal income tax at the end of the year. One of the features of withholding tax, we also say withholding tax is a frank. Some of the withholding tax represent final tax on frank investment income. We have some income where withholding tax is deducted on them. That withholding tax deducted on such income is a final tax. That means that withholding tax cannot be used to offset final tax liability at the end. It cannot be used to offset tax liability at the end of the year. Such withholding tax, such income is called frank investment income. So that is what we have said earlier. Advantages of withholding tax. One of the advantages of withholding tax is it enhances voluntary compliance. It enhances voluntary compliance. Another advantage of withholding tax is it creates more awareness on taxation. Another advantage of withholding tax is it creates more awareness on taxation. Why another advantages of withholding tax? It reduces the incidence of tax evasion. It reduces the incidence of tax evasion. Why? We also have another benefit or advantage of withholding tax. It helps to bring unknown taxpayer into tax net. Withholding tax is going to increase tax net because more people is going to be at the tax net. Because withholding tax, there is no how you are going to escape it. If you render service to me, if I want to pay you a professional service, before I pay you that professional service, I must deduct withholding tax. The law mandates me to deduct withholding tax from that your income I want to pay you and remit it to the tax authority. So that is the whole essence. So more people is going to be at the tax net. So through withholding tax. So these are the advantages and benefit of withholding tax. What are the disadvantages of withholding tax? High rate of withholding tax is likely to affect the operational performance of most of the business. High rate of withholding tax is likely to affect the operational performance of most of the businesses. If withholding tax rate can be 5%, it can be 2.5%, it can be 2%, it can be 10%, it can be 15%. It depends on the nature of the service. It depends on the nature of the service and the type of the persons that receive the income. The withholding tax rate for company is different from withholding tax rate for individual. According to Withholding Tax Regulation 2024, the withholding tax rate for resident taxpayer is different from withholding tax rate of non-resident taxpayer. So one of the disadvantages of withholding tax again is it discourages hard working by revenue officer. It discourages hard working by revenue officer since it is self-accounting in nature. Since it is self-accounting in nature. Another disadvantage of withholding tax is application of withholding tax. Applications of withholding tax affect cash flow of most of business. Application of withholding tax affects cash flow of most of the businesses. Application of withholding tax affect cash flow of most of the businesses. So these are the disadvantages of withholding tax. Now let's look at type of withholding tax. Type of withholding tax. Generally, there are two types of withholding tax. We have withholding tax payable and withholding tax claimable. Withholding tax payable and withholding tax claimable. Withholding tax payable means those withholding tax that you deduct from the payment of service rendered by to your company. The withholding tax payable means the withholding tax deducted from the payment made by the company to a third party. Withholding tax deducted from the payment made by the company to a third party is called withholding tax payable. While withholding tax claimable means withholding tax deducted from the income received by company. Withholding tax deducted from the income received by the company. Note, you cannot use withholding tax claimable to offset withholding tax payable. Note, you cannot say you want to deduct withholding tax payable from withholding tax claimable. They are different. They are different. You cannot use withholding tax payable to offset, to reduce your withholding tax claimable. No, you have to go and remit withholding tax payable. Your withholding tax claimable, you have to use it to reduce your tax. You can either use it to reduce your company income tax, or you use it to reduce your personal income tax. That is withholding tax claiming. Due date of payment of withholding tax. What is the due date of payment of withholding tax? What is the due date of payment of withholding tax? What is the due date of payment of withholding tax? The due date of payment of withholding tax depends on the receiver of the income. If the receiver of income is a company, the withholding tax must be payable to the Federal Inland Revenue Service not later than if the receiver of the income is a company, the withholding tax deducted must be remitted to Federal Inland Revenue Service not later than 21st day of the following month of the transaction, not later than 21st day of the following month of the transaction. But if the receiver of the income is an individual, sole proprietorship, partnership, that withholding tax must be remitted to State Internal Revenue Service not later than 30 days from the 30 days of the month following the month of payment. Not later than 30 days of the month following the month of payment. That is the due date of withholding tax. Note, while making payment of withholding tax, you must provide the tax identification, the nature of transaction, the name of the receiver of the income. That will take off to the content of withholding tax return or content of withholding tax payment schedule. What are the content of withholding tax payment schedule or content of withholding tax return? Number one, the name and address of the taxpayer acting as the agent of the government. The name and address of the taxpayer acting as, that means the name and address of the persons that deduct withholding tax, the company that deduct that withholding tax must be stated. Second, the name and address of the relevant tax authority to which the withholding tax to which the withholding tax is remitted to, the name and address of the relevant tax authority to which withholding tax is remitted to. Another one, the name and address of the beneficiary. Who is the beneficiary? The receiver of that income. That person that received the income, the name and address of the receiver of the income must be stated in your withholding tax return or in your withholding tax payment schedule. The nature of transaction. What kind of transaction do you render? Is it rent? Is it interest? Is it professional service? Is it contract supplies? Is it royalties? Is it dividends? Is it director fees? The nature of transactions must be stated. The gross amount of the transaction. The gross amount of the transaction means that amount that you want to pay to the receiver of the income before deduction of withholding tax. The amount you want to pay to the receiver of the income before deduction of withholding tax. That is the gross amount. Why the rate of withholding tax? What rate are you using to compute your withholding tax? Are you using 10%? Are you using 5%? Are you using 15%? You have to state the rate, part of your withholding tax return. The amount of withholding tax deducted, how much is the withholding tax deducted? The tax identification number of the beneficiary of that withholding tax, which means the receiver of the income, the tax identification number of that beneficiary must be stated. Another one, the date of payment. The date you want to make payment for the withholding tax. The date you want to make payment for the withholding tax. These are the content of withholding tax return or content of withholding tax payment schedule. Content of withholding tax payment schedule or content of withholding tax return. The name and address of the taxpayer, which is the agent, the name and address of the beneficiary, the name and address of the tax authority, the gross amount of the transaction, the rate of withholding tax, the amount of withholding tax deducted, the tax identification number, date of payment. Now, these are the content of withholding tax. The next area we need to look at, refund of withholding tax. How do you claim refund of withholding tax? If at the end of the year, as a company, the withholding tax deducted on your income is high, is higher than your company income tax. If at the end of the year as a company, while you are computing your company income tax, you now discover that the withholding tax deducted from your income at source is more than your company income tax liability, you can claim a refund in accordance with section 63 of company income tax. You can claim a refund in accordance with section 63 of company income tax. Such refund must be made in writing within 90 days after the end of the year, after the date of the tax computation, after the date that you discover that you have excess withholding tax. You must make application for refund within 90 days, and that application must be directed to who? FRS. I'm referring to company. From your income, they deduct withholding tax as such. When you are now doing your final tax liability, you now discover that the company income tax that you are going to pay is less than the withholding tax deducted. That means you have excess withholding tax credit note. That overpayment of withholding tax credit note must be what? must be claimed within what? 90 days. Within 90 days. That overpayment of withholding tax must be claimed within 90 days from the date of application. However, if you don't want to claim withholding tax refund, that excess withholding tax you have, you can use it to offset what? Your future tax in the future year of assessment. In the next year of assessment, the excess withholding tax you have in the current year of assessment, you can use it to offset your tax liability, your company income tax liability in the next year of assessment. That means you can carry withholding tax credit note forward to offset your future tax. That is refund of withholding tax. The next thing we need to look at, withholding tax exemption. Who are the company that are exempted from withholding tax? Any company that have turnover of 25 million or less, any company that their turnover is 25 million or less, they are exempted from payment of withholding tax. They are exempted. That means a small company, if a small company renders service to you, you should not deduct withholding tax from their invoice, since they are a small company. However, as a small company, you are expected to deduct withholding tax for any service rendered to you or any transaction rendered to you that the transaction is more than what? 2 million naira. If you are a small company means a company that their turnover is 25 million or less. As a small company, you are not expected to pay withholding tax because small companies don't pay company income tax. So why do you now deduct withholding tax from small company invoice? You don't need to deduct withholding tax on a small company invoice. However, small company, if they render service to small company, you need, yes. You need, if you render service to a small company and the transaction of that service is 2 million, that transaction is expected to, a small company is expected to deduct withholding tax on such transaction that is 2 million and above. That is exemption of withholding tax. That is exemption of withholding tax. So for the sake of time, let's look at withholding tax rates. According to withholding tax regulation 2024, what is the withholding tax rate? The rate of withholding tax. The rate of withholding tax is now divided into two. Rate of withholding tax for company, rate of withholding tax for individual. Rate of withholding tax for company. In the case of company, the withholding tax rate, if it is resident, 10 for dividend and interest. If it is a non-resident company, 10% too. That means withholding tax rate for dividend and rent for resident company, non-resident company, for resident individual, non-resident individual is 10% true. But withholding tax rates for royalty, for resident company, 10%. non-resident company, 10%. But for non-resident company, for individual, they are 5%, 5%. For individual, they are 5%, 5%. So this withholding tax rate is going to be given to us in the exam. At the back of our exam notes, they will give us withholding tax rate. The major one that we need to know, professionals or management or technical service. If you render professional fee, what is the withholding tax rate? The withholding tax rate for professional fees, if that company that rendered the professional fee, professional service, is a resident company, withholding tax rate is 5%. But if that company is an individual, is a non-resident company, the withholding tax rate is 10%. If the service is rendered by individual, if that individual is a resident individual, the withholding tax rate is 5%. If that individual is a non-resident individual, the withholding tax rate is 10%. So this rate will be given to us in the exam. What are the transactions exempted from withholding tax? What are the transactions exempted from withholding tax? What transactions that are exempted from withholding tax? Number one, across-the-counter transaction. Across-the-counter transaction means direct purchases. Direct purchases. If they ask what are the nature of transactions that attract withholding tax or nature of service that attract withholding tax, who can tell me those services that attract withholding tax or transactions that attract withholding tax? Number one, dividend attract withholding tax. Interest attract withholding tax. Rent attract withholding tax. Professional service or professional management service attract withholding tax. Contract supplies attract withholding tax. Construction contract attract withholding tax. Director fee attract withholding tax. Compensation for loss of office attract withholding tax. All these transactions in this table, they are those transactions or services that are subjected to withholding tax. You can be asked, what are those 10 services that are subjected or 10 transactions that are subjected to withholding tax? Dividend transactions, interest transactions, royalty, rent transaction, professional service, contract supply service, brokerage service, construction service, director fee. All these attract withholding tax. Now, what are those transactions that are exempted from withholding tax? Transactions exempted from withholding tax. Number one, across-the-counter transactions. Across-the-counter transaction. Across-the-counter transaction means instant payment transactions. Instant payment transaction means direct purchases. You went to Spar to go and buy 10 laptops and you pay them through your ATM card. You cannot tell Spar that you want to deduct withholding tax because that one is direct purchases. You are not giving Spar a contract to come and supply you a laptop. But if you give a Spar or IT company a contract to come and supply you 10 units of laptop, that one is a contract supply. It's going to attract withholding tax. But if you went to Computer Village, you now went to a laptop mall to go and buy laptop, you are not giving them a contract. That one is across the counter transaction. You cannot say you want to deduct withholding tax on such transaction. But if you said, HPO, I want to give you a contract to come and supply us 100 laptops, that one is contract supply. It will attract withholding tax. So contract supply will attract withholding tax. Across the counter transactions does not attract withholding tax. Another transaction exempted from withholding taxes, good or material produced by persons making the supplies. Good or material produced by persons making the supplies. It does not attract withholding tax. Imported goods. So if you import goods, you import a good, you want to order a good in abroad. Where do you want to order the good? You cannot say you want to deduct withholding tax from where you want to order the good in abroad, because it's an imported good, does not attract withholding tax. Except if the company that want to sell that imported good to you, if the company that is outside Nigeria, that they want to sell the imported good to you, they have office in Nigeria. If they have office in Nigeria, you can deduct withholding tax. But if that company does not have office in Nigeria, you cannot deduct withholding tax. Another transaction that are exempted from withholding taxes, interbank interest. If a bank borrowed money from another bank and that bank charge interest, the interest charged by another bank, you cannot deduct withholding tax on it. Another transaction exempted from withholding taxes, insurance claim. If you receive insurance claim or you pay insurance premium, if you pay insurance premium to insurance company or you receive insurance claim, your insurance company cannot deduct withholding tax from the claim they want to pay you. And if you too want to pay them a premium, you cannot deduct withholding tax. Another one, supply of PMS, AGO, liquefied natural gases, CNG, PMS, AGO. If you supply any oil and gas product, if you do contract supply of any oil and gas product, such products are exempted from deduction of withholding tax. Supply of any oil and gas product are exempted from deduction of withholding tax. Another one is dividend paid by real estate investment company. If a real estate investment company paid a dividend to their shareholder, they are not expected to deduct withholding tax on such dividends. A real estate investment company, if they pay dividend to their shareholder, they are not expected to deduct withholding tax on such dividend. So all these are the transactions exempted from withholding tax. All these are the transactions exempted from withholding tax. Now, the next area we need to talk about, withholding tax credit note. What is withholding tax credit note? Withholding tax credit note is a document. Withholding tax credit note is a document issued to the taxpayer by who? By relevant tax authority. It is issued to taxpayer by the relevant tax authority to serve as an evidence that withholding tax has been deducted from income. Withholding tax credit note is a document or certificate issued by who? By the relevant tax authority to a taxpayer to serve as an evidence that withholding tax has been deducted from such income at source. If you want to use withholding tax to reduce your tax liability at the end of the year, you need to first of all get a certificate from the tax authority. That certificate is called withholding tax credit note. That certificate is called withholding tax credit note. It is a document issued by the relevant tax authority to a taxpayer to serve as an evidence that withholding tax has been deducted from the income at source. That is withholding tax credit notes. Content of withholding tax credit. What are the content of withholding tax credit? Number one, the credit note number. Withholding tax credit note normally have a number. That credit note number is very important. That withholding tax credit note number is very, very important. When you want to claim withholding tax, when you want to use withholding tax to reduce your company income tax, one of the things that you must provide to the tax authority is the credit note number. The number two content of withholding tax credit note, the name of the taxpayer who deduct withholding tax and remit the withholding tax. Number three content, the name of the beneficiary. Beneficiary means the name of the person that received that income in which withholding tax was deducted. Beneficiary means the name of the persons that received the income in which what withholding tax was deducted. Another content of withholding tax credit note is nature of transaction. The nature of transaction. The nature of transactions. While another content is the date of transaction. The date of what? Transaction. We have another content, the name of the bank through which remittance was effected. The name of the bank through which remittance was effected. These are the content of withholding tax credit notes. These are the content of withholding tax credit notes. Now, the next area we need to look at is double taxation relief and withholding tax. Does withholding tax apply to double taxation relief? There are some income that suffer double tax. Such income, if you want to deduct withholding tax on income that has already suffered tax outside the country, the withholding tax rate you are going to deduct on income that has suffered tax outside the country is going to be what? 7.5% rate. If income has suffered tax outside the country, you now bring the income to Nigeria, you want to deduct withholding tax on that income again in Nigeria, so that it's going to be double tax. The withholding tax rate you are going to deduct on such income is going to be at the rate of what? 7.5%. Example of income that can suffer tax outside Nigeria: interest, dividend, royalties. You can receive such income outside Nigeria. If you are a Nigeria resident, if you take them to Nigeria again, you are going to pay another tax. And Nigeria tax authority would like to deduct withholding tax. If they want to deduct withholding tax on such income, it's going to be at 7.5%. Or if a non-resident individual or a non-resident company come to Nigeria to render service, you don't need to compute company income tax on the profit of a non-resident company that receive income in Nigeria. You just need to deduct a one-off withholding tax. That one-off withholding tax you are going to deduct is going to be at the rate of what? 7.5%. Let me repeat again. A non-resident company that is not registered or located in Nigeria, if they come to Nigeria to render service, and they receive income, you don't need to say they should pay company income tax. You will only deduct a one-off withholding tax, and that withholding tax will be a final tax, and that withholding tax is going to be at the rate of what? 7.5%. Because that non-resident company, when they take that income to their country, they are still going to pay tax, and that will be a double taxation. So you will only deduct withholding tax rate of 7.5%. Now, what are the offenses and penalties relating to withholding tax? What are the offenses and penalties relating to withholding tax? Number one offenses and penalties relating to withholding tax is when you fail to pay withholding tax at the deadline date. Failure to pay withholding tax at the deadline date, which is either 21 days or 30 days. If you fail to pay withholding tax at the deadline date, you will pay a penalty of 10% of the amount of withholding tax not paid, plus interest at prevailing commercial rate. When you fail to pay withholding tax at the deadline date, at the due date of withholding tax return, what is the penalty? The penalty is 10% of the amount of withholding tax not paid, plus interest at what? Prevailing commercial rate. That is number one offenses. Another offenses that we have relating to withholding taxes: failure to deduct withholding tax. What is the failure to deduct withholding tax? According to withholding tax regulation at 2024, failure to deduct withholding tax is going to attract administrative penalties and a one-off annual interest. Failure to deduct withholding tax, according to withholding tax regulation 2024, is going to attract administrative penalties and one-off annual interest. So those are the offenses and penalties relating to withholding tax. Those are the offenses and penalties relating to withholding tax. The next area we need to look: currency of deduction. Currency, which currency are we going to use to deduct withholding tax? The currency that we are going to use to deduct withholding tax depends on the currency of the transactions. Depends on what? The currencies of the transaction. If the transactions, if the income was paid in dollar, the withholding tax you are going to deduct is going to be in dollar, and you are going to remit the dollar amount to the who? To the Federal Inland Revenue Service. But if the transaction was paid in naira, the withholding taxes that will be deducted will be in naira. And the naira will be paid to the Federal Inland Revenue Service. Why withholding tax is deducted in foreign currency? If you want to remit it to the Federal Inland Revenue Service, you will remit it in naira equivalent by using the current exchange rate fixed by CBN. If a withholding tax deducted in foreign currency, if you want to remit it to the Federal Inland Revenue Service, you are going to remit it in naira, but you are going to convert that foreign currency to naira equivalent using the exchange rate fixed by CBN, which is the prevailing exchange rate. That is currency of deduction. The next thing we need to look at is frank investment income. What is frank investment income? What is frank investment income? Frank investment income are those income that withholding tax deducted, that suffer withholding tax, and the withholding tax suffered by such income is a final tax. Frank investment income is the income that withholding tax deducted from such income is a final tax in the hand of recipients. Example of frank investment income: dividend. Some of the interest too, they are frank investment income. Some of the interest too, they are frank investment income. If a shareholder want to pay dividend to, if a company want to pay share dividend to shareholder, the withholding tax deducted by the company on the dividend is a final tax, because dividend is a frank investment income. That means that withholding tax, the shareholder cannot use it to offset his final tax liability at the end of the year. The shareholder cannot use it to offset his company income tax. And such income too will not be regarded as a taxable income. Any income that withholding tax is deducted as a final tax, such income cannot be regarded as a taxable income. Such income is going to be treated as a non-taxable income. That withholding tax deducted on the income cannot be used to offset company income tax liability at the end of the year. Majorly, most of the income that attracts frank investment income, they are dividend and what? Interest. There are some dividend. Most of the dividend paid by company to their shareholder, the shareholder will deduct withholding tax, and that withholding tax deducted by the shareholder is a final tax. Shareholder will not deduct any dividend again. In that case, that withholding tax cannot be used to offset company income tax at the end of the year. Likewise too, there are some interest that they normally deducted, bank normally deducted from our account. There are some withholding tax bank normally deducted every month from the interest paid into our bank account. If we have a bank account, maybe you have a savings account with your bank, at the end of every month, bank will be paying you interest on those savings. That savings, that interest paid to you by bank on your saving, bank will deduct withholding tax rate of 10%. That withholding tax rate deducted by bank on such interest is a final tax. You cannot use it to offset your final tax liability. But in the case of interest on fixed deposit, the withholding tax deducted on interest on fixed deposit is not a final tax. You can use that withholding tax deducted on interest on fixed deposit to offset your final tax liability, to offset your company income tax. That is frank investment income. The major area we need to look at, the last area we should look at, is differences between withholding tax and VAT. What are the differences between withholding tax and VAT? What are the differences between withholding tax and VAT? Withholding tax is an indirect tax. Withholding tax, VAT is an indirect tax, while withholding tax is a direct tax. VAT is an indirect tax, withholding tax is a direct tax. Another difference, VAT is imposed on goods and services, while withholding tax is imposed on income at source. VAT is imposed on goods and services, while withholding tax is imposed on income at what? At source. VAT is imposed at the rate of 7.5%, Withholding tax rate depends on the nature of the type of the transaction or nature of the transaction. Another difference in terms of rate, the rate of VAT is 7.5%, while the rate of withholding tax depends on the nature of transaction. Another difference is withholding tax, VAT VAT is collected by FRS. Withholding tax can be collected by both FRS and state internal revenue service. Withholding tax can be collected by both FRS and what? State internal revenue service. Another difference, VAT is shared by the 3 tiers of government, while withholding tax is not shared by the 3 tiers of government. So this is what we have on withholding tax. This is what we have on withholding tax. Let's look at questions on withholding tax so that we go to the next topic. Let's look at questions on withholding tax so that we go to the next topic. First examinable question. Administration of withholding tax is the responsibility of relevant tax authority. State the relevant tax authority responsible for administration of withholding. State the relevant tax authority responsible for administration of the following. Company, who is the relevant tax authority that will collect withholding tax on company? That will be Federal Inland Revenue Service. For firm means partnership, business name. Who is going to collect their withholding tax? State Internal Revenue Service. For resident of FCT, who is going to collect their withholding tax? FCT Internal Revenue Service. For professional, who is going to collect their withholding tax? State Internal Revenue Service. For individual, who is going to collect their withholding tax? State Internal Revenue Service. The major area we need to look at, one of the major areas that we need to look at is examinable question 5. Let's look at examinable question 5. Examinable question 5. Examinable question 5. Examinable question 5. Somebody should help us read this question 5. Question 5. Somebody should help us read.
Sir, I'll read. Adebola Nigeria Limited has been trading for many years. The company make up its account to December 31st annually. Sir, please can you scroll down? I will scroll up. Okay, thank you. The company makes up its account to December 31st annually. The extract from its statement of profit or loss for the years ended December 31st, 2025 and 2026, I'm guessing that should be 2026, as adjusted for tax purposes as follows. The table has been given below. Required. Compute the company tax liabilities for the relevant years of assessment. Ignore capital allowances. Then B, determine the net withholding tax payable or receivable by Adebola Nigeria Limited arising from dividends paid and received by it.
Okay, thank you very much. Adebola Nigeria Limited has been in trading. They now give us their turnover. They give us their trading profit adjusted. They give us their bank interest gross. They give us interest on government stock. They give us rental income. They give us debentures. They give us dividend received. They give us dividend paid. First requirement said we should compute the tax liability of Adebola Limited. What kind of tax Adebola Nigeria Limited is going to pay? What kind of tax are they going to pay as a company? Adebola Nigeria Limited, what kind of tax they are going to pay? They are going to pay company income tax and what? And tertiary education tax.
Yeah.
From this profit, they will pay company income tax and tertiary education tax. Looking at this question, they say trading profit adjusted, meaning profit coming from trading only. They have already adjusted. Is one of the income. Another income, bank interest received gross, is one of the income. Interest on government security, rental income net, debentured interest received. Now, if you want to compute the tax liability now, the name of the company, Adebola Nigeria Limited, computation of tax liability. The first year end given to us, 2025. Why the second year end given to us is 2026? Why computing tax liability? For the year end 2025, that one is going to be computed on what year of assessment?
2026.
2026. Why for the year end 2026? That one is going to be computed for what year of assessment?
2027.
So that is the reason why I write for the relevant year of assessment. The first year of assessment I have 2026. Why the second year of assessment I have is what? 2027. Let me start from the first income. Trading adjusted profit. Trading adjusted profit. 14 million and 10 million. I will write that. It's an income. Another income I will write. Bank interest received. It's an income. I will write it too. Interest on government stock is an income too. Am I going to write it or I will not write it? Interest on government stock.
No, government stock is not taxable.
It's a non-taxable income.
Income.
So
yes.
I will not use it. I will not use it. Rental income. Rental income is taxable. Rental income is what? Is taxable. But it is stated in the net.
Yeah, that
net means what?
Withholding tax has been paid.
They have deducted withholding tax. If I want to show it in the tax computation, I must convert it to what?
Gross.
Gross. I must convert this net. I must convert it back to what? Gross.
Gross.
This rental income is, what is the withholding tax rate on rent? The withholding tax rate on rent is 10%.
For companies,
if you go and look at the table, it's 10%.
For company, yes.
Rent, 10% true. So that means they have deducted withholding tax on this rental income. They are now showing the net. How do I get the gross? If I want to get the gross, since I know that this 3.6 million is the 90%, net is 90%. Gross will be how many percent?
100.
100%. Yeah. The difference between 100 and 90 is 10%. That is the withholding tax. This one is 90%. To make it 100, I will add back withholding tax. If I want to make it 100, what am I going to do? I will set 100 over 90. 100 over what?
90.
90 times what? 3.6. 100 over 90 times 3.6 million is going to give us 4 million. 100 over 90 times 4.5 million is going to give us 5 million. Do you understand how we get that?
Yes.
Another one we have, another income that we have for Adebola, dividend, debentures interest received. Debentures interest is taxable. It's already gross. I will write it. It's already gross. I will write it. Another income I have is dividend received. Adebola received a dividend from another company. It's an income to them now. Am I going to write it while computing tax? Dividend received.
No,
It's an income.
because it's frank investment.
That's frank investment.
I will not write it.
Yes.
I will not write it while computing my tax liability, because dividend is a frank investment income. So it's a non-taxable income. The tax deducted on dividend is a final tax. So I will not write it while computing my tax liability. So at the end of the day, the total adjusted profit for the first year is 21,200,000, while the total adjusted profit for the second year is 17,400,000. If I less capital allowance from there is no capital allowance in this question. That means my total profit will still remain 21,200,000, 17,400,000. Now, let me compute my tax liability. Let me compute my what? Tax liability. For the first year, if I want to compute company income tax, what rate am I going to use for the first year? Who can tell me what rate am I going to use? If I want to compute for company income tax, what rate am I going to use for the first year?
Not 30%.
20.
Am I going to use? I'm going to use 30, Abi?
Yes.
30 or 20?
20.
Why 20? Why 30?
20.
Their
If you look
turnover
at
is
the
not up to 100 million.
turnover of this company, apart from the turnover, this is turnover. Turnover is coming from trading adjusted profit. Apart from turnover, if we add all other income to turnover, is it up to 100 million? Is it more than 100 million? If we add bank interest, interest on government stock, rental income, you will not add interest on government stock. If we add bank interest, rental income, the pension interest to turnover, is it up to 100 million? No, it's not up to 100. It's not more than 100 million. So that means the CIT I'm going to use for this first year is going to be 20%. That means 20% of 21,200,000. It will give me 4,240,000. 4,240,000. 4,240,000. 4,240,000. For the second year, what rate of company income tax am I going to use? 20 or 30? What rate of company income tax am I going to use for the second year?
30.
Why?
The turnover is above 100 million.
The turnover or the total income? Turnover is 94,500,000, abi? If we
Yes,
add
but if you had every other
94,500,000
income for it, you will have more
plus
than 100 million.
1.6 plus 4.5 plus 800, definitely it will be more than 100 million. So I'm going to use 30%. 30% of 17,400,000. 30% of what? 17,400,000. That will give you 5,220,000. That is the company income tax that the company is supposed to pay. From this company income tax that this company is supposed to pay, there are some income that they have deduct withholding tax from them at source. There are some income they have deduct withholding tax on them at what? Source. And with less that withholding tax deducted on such income at source, what are those income that attract withholding tax at source in this income? Number one, bank interest. Interest attract withholding tax. What is the withholding tax rate on interest? 10%. 10% of the gross, 10% of 2.4 million. It will give you, that means withholding tax on interest, on bank interest is 240,000. Another one, rental income. Rental income to attract withholding tax. 10% of the gross, 10% of 4 million, it will give you 400,000. Another one, debentures interest. Debentures interest to attract withholding tax. 10% of the 800,000, it will give you 80. That means the net CIT, the net company income tax that this company will pay is going to be 3,520,000 for the first year of assessment. Why for the second year of assessment? That one is going to be how much? 4,480,000. We normally deduct withholding tax from the CIT. What the second tax that the company will pay, tertiary education tax, 3% of adjusted profit, 3% of 21,200,000, 636,000 naira, 3% of 17,400,000, that is 522,000 naira. That is the company income tax liability. That is the tax liability of the company. The second question said, compute the net withholding tax payable or receivable by Adebola Limited arising from dividend paid and dividend received. How much dividend was paid by Adebola to their shareholder? Look at the dividend paid by Adebola to their shareholder. 6 million, 4 million. Why dividend received? The net 720, 720. I'll have to gross it back. If I gross it back, 100 over 90. Adebola Limited, when they want to pay dividend to their shareholder, they will deduct dividend from this 6 million. They will deduct 10% dividend. From this 4 million, they will deduct 10% dividend. Why Adebola Limited too is receiving dividend from another company? That company has deducted dividends. So I want to look at the balance. Dividend received from Adesemowo Limited. That means the dividend income of Adebola, 100% over 90 times the net times 720. It will give you 800. The dividend income of Adebola Nigeria Limited for the 2 years is 800,000. What is the withholding tax on this dividend income? 10% of it, 10% of 80,000. That is the withholding tax on dividend received. How much dividend was paid to the shareholder by Adebola Nigeria Limited? 6 million dividend was paid. 4 million dividend was paid for the second year. What is the withholding tax on that dividend paid? 10% of 6 million, 600,000. 10% of 4 million, 400,000. Net withholding tax paid 600 minus 80. 600,000 minus 80,000, 520,000. 320,000, 400,000 minus 80,000, 320,000. That is the withholding tax payable on dividend. So that is what we have on that question. That is the major thing we have in this question. So we have so many other questions relating to dividends. But let's look at question 8, examinable question 8. Examinable question 8. What does examinable question 8 say? Somebody should help us read. Examinable question 8.
Withholding tax is the deduction of tax at source from payments made to a taxable person. However, some dividends are exempted from withholding tax. Required, briefly explain 5 dividends exempted from withholding tax.
When you talk about dividend and withholding tax, you are going to look at it in 2 angles. Some dividends, their own withholding tax is called final tax. Some dividends, their own withholding tax is a final tax. They are called frank investment income. However, there are some dividends, you will not even compute withholding tax on them at all. They are not expected to pay withholding tax on them. Such dividends, they are those dividends that are exempted from tax. Some dividends are finally exempted from tax, apart from frank investment income. You will not pay tax on them. On frank investment income, you have paid tax at source. You have deduct withholding tax at source. That withholding tax you deduct at source is a final tax. That is frank investment income. However, there are some dividends that the withholding tax on them is finally exempted. That means you are not going to compute withholding tax on them at all. They are not a frank investment income. That means you will not pay withholding tax on them. If shareholder want to pay, if a company want to pay that dividend to shareholder, they will not deduct withholding tax at all on that dividend. That withholding tax is a free tax. That dividend is a free tax dividend. is not subjected to any tax. What are those dividends that are not subjected to tax? If a dividend is not subjected to tax, you will not deduct withholding tax on such dividend too. You may be asked, what are those dividends exempted from tax? Another way they can ask that question is, what are those dividends exempted from withholding tax? What are those dividends exempted from withholding tax? Who can mention those dividends exempted from withholding tax? Number one dividend exempted from withholding tax: dividend paid to the shareholder in a certain tax-exempt entity. There are some companies, they are not subjected to tax. They are charitable organizations. If they pay dividend to their shareholder, dividend paid to their shareholders too is not going to be subjected to tax, because the company profit is not subjected to tax. So number one dividend exempted from withholding taxes: dividend paid to shareholder in a certain tax-exempt entity. Another one is dividend derived outside Nigeria. When you derive dividend from your foreign shares or foreign investment, if you brought the dividend to Nigeria through approved channel, that dividend will be exempted from tax. Dividend derived outside Nigeria and brought back to Nigeria through government approved channel is going to be exempted from tax. Another dividend exempted from taxes: dividend paid by unit trust company, a company that engage in unit trust business. If they pay dividend, that dividend is finally exempted from tax. So you will not deduct withholding tax on such dividend. Another one is dividend paid by real estate investment company. If a real estate investment company pay dividend, that dividend will be exempted from tax, or is going to be exempted from withholding tax, provided that 75% of such income of the dividend is distributed. 75% of such income of such income of the real estate investment company is distributed as dividend within 12 months. 75% of such income of a real estate investment company is distributed as dividend within 12 months. That dividend is going to be exempted from tax and is going to be exempted from withholding tax. Another dividend exempted from tax, or dividend exempted from withholding tax: dividend paid received from wholly export-oriented business. If a company is engaged in export business, that company, they're located in free trade zone or export processing zone. If they pay dividend to their shareholder, such dividend is going to be exempted from withholding tax and is going to be exempted from any tax. Dividend paid by a small company: we know small company is not going to pay tax. Small company means those companies that their turnover is less than 25 million. If they pay dividend from that profit that is exempted from tax, that dividend too is going to be exempted from withholding tax. Another dividend exempted from withholding tax: dividend paid by pioneer company. If a pioneer company during pioneer period pay dividend to their shareholder, that dividend too is going to be exempted from withholding tax. So these are the dividends exempted from withholding tax. So please, let's take note of this area. So this is what we have so far on dividend. So there are some other questions that time will not permit us to answer, but the solution is there already. You can look at those questions time will not permit us to answer those questions. So the solution is there already. So that is what we have on dividend so far. So the next topic we are going to look at is called tax evasion and avoidance. The next topic we are going to look at is called tax evasion and avoidance. Tax evasion and avoidance. Let me share the material. Tax evasion and avoidance. Tax evasion and tax avoidance. What is tax evasion? What is tax avoidance? Tax evasion and tax avoidance. What is tax evasion? What is tax avoidance? Tax avoidance is a method of avoiding tax within the limit of the tax law. Tax avoidance simply means a legal way or legal means of reducing tax liability. Tax avoidance can also be referred as the process of identifying the loopholes in the tax law and take advantage of such loopholes in order to reduce what? Tax liability. Tax avoidance means the process of identifying the loopholes in the tax law and take advantage of such loopholes in order to reduce what? Tax liability. That is tax avoidance. It is a legal way of reducing your company tax liability. But in the case of tax evasion is a criminal act or illegal way of avoiding tax through manipulation of record, manipulation of accounts. Tax avoidance is an illegal way of avoiding tax through manipulation of company record or manipulation of accounts. It is a criminal act. It is against the law. That is tax evasion. That is tax evasion. Let's look at differences between tax evasion and avoidance. What are the major differences between tax evasion and tax avoidance? What are the major differences between tax evasion and tax avoidance? Number one, in terms of meaning, tax evasion means tax avoidance means minimization of tax liability within the limit of tax law. While tax evasion means reducing tax liability using illegal way. I'm looking at the difference between tax avoidance and tax evasion. Number one difference in terms of meaning. Tax avoidance means minimization of tax liability using legal means. While tax evasion means reducing tax liability using illegal way. Another one terms of the concept, tax avoidance is egging of tax. Tax avoidance mean what? Egging of tax. Tax avoidance relate to defer tax. You defer tax avoidance means you defer the tax you're supposed to pay now. You defer it to future period. But tax evasion means concealment of tax. That is another difference. Concealment of tax. In terms of attributes, tax avoidance is immoral in nature. It's immoral, but is within the law. But in the case of tax evasion, it's illegal and it is against the law. In terms of timing, tax avoidance occur before the tax liability, while tax evasion occur after tax liability arises. In terms of timing, tax avoidance occurred before tax liability, while tax evasion occurred after tax liability arises. In terms of consequence, the consequence of tax evasion. What is the consequence of tax avoidance? The consequence of tax avoidance is minimization of tax, deferment of tax liability. While the consequence of tax evasion is penalties or imprisonment. If a taxpayer practices tax evasion, is going to pay penalties and interest. If tax authority discover that taxpayer is engaged in tax evasion, sometimes that taxpayer may be imprisoned. They may charge the taxpayer to court, and in the long run, is going to be sentenced to prison. So one of the consequences of tax evasion is either penalties or imprisonment. But the consequence of tax avoidance is deferment of tax liability. So these are the major difference between tax evasion and tax avoidance. These are the major difference between tax evasion and tax avoidance. Now, another thing we need to look at. We have looked at the differences. Another thing we need to look at now is reasons for tax evasion and tax avoidance in Nigeria. Why does company engage in tax evasion and tax avoidance in Nigeria? What are the reasons for tax evasion and tax avoidance in Nigeria? One of the reasons for tax evasion and tax avoidance in Nigeria is absence of compensation from the government. Absence of what? Compensation from the government. Governments don't compensate the taxpayer. They don't compensate the taxpayer. They don't compensate the taxpayer. Taxpayers believe that what they are paying for, the tax that they are paying, government are not using it for what they're supposed to use it for. taxpayer believe that the tax government is paying, they are not using it for the purpose that they're supposed to use it for. That after all, government is embezzling, government normally mismanage the tax fund. So why am I going to pay tax? That discourages some people to pay tax. And those who are paying tax, government is not encouraging them. Government is not supporting them. Another one, minimization of funds realized from tax remittance. The taxpayer believe that government mismanagement of funds realized from tax remittance. The taxpayer believe that government mismanage the tax fund. The taxpayer believe that government they mismanage the tax fund. They don't manage the tax fund very well. So that one discourage them from paying tax. Lack of knowledge of civil responsibility. Lack of knowledge of civic responsibility is one of the reasons for tax evasion and avoidance in Nigeria. In the constitution, one of the major responsibility of the citizen of Nigeria is to pay tax. But people don't know their civic responsibility that they're supposed to pay tax. They are not aware. Another one, legality of tax avoidance. Since tax avoidance is legal, people will take advantage of it to reduce government tax. Now, for the sake of time, what are the ways or method in which taxpayer can practice tax avoidance? What are the ways or method in which taxpayer can practice tax avoidance? What are the ways or method in which taxpayer can practice tax avoidance? Number one, purchase of qualified capital expenditures. Purchase of what? Qualified capital expenditure. If a company buy qualified capital expenditure, they will claim what? What is the benefit of acquiring qualified capital expenditure? They will claim capital allowance. That capital allowance they are claiming is a form of tax avoidance.
True.
It's a form of what? Tax
avoidance. Oh, face on tax.
Another way, contribution to approved pension scheme and national housing fund. This one apply to personal income tax. Payee from the staff salary. If a company want to reduce the tax, personal income tax staff will pay, they can contribute to national housing fund. That 8% of basic housing and transport deducted from the staff salary, company normally use it to reduce tax. Is a form of tax exemption to reduce the tax, personal income tax that the staff will pay. Another one that we have, national housing fund. What is the rate of national housing fund? 2.5% of basic salary. That 2.5% of basic salary that company deducted from the staff salary as national housing fund, in the long run, is going to reduce the tax, personal income tax of the staff. So if company want to engage in tax avoidance, they will be contributing more to pension scheme And this pension scheme is an income to the staff in order to reduce his personal income tax. Another way of tax avoidance is donation to approved bodies listed in the 7 schedules of SITA, either 7 schedule or 5th schedules of SITA. There are some organizations that we are allowed to donate to. If we donate to those organizations, that donations is an allowable expenses. We are going to use it to reduce our tax. Another way in which company can practice tax avoidance is payment of reimbursable expenses to staff. Payment of reimbursable expenses to staff. They can use that to avoid tax, to reduce the tax, personal income tax that the staff pay, and to reduce the company income tax that the company will pay. Another way that company can practice tax avoidance, investment in government what? Security. If a government invests in government security, government security is not taxable. It's going to reduce tax of the company. They are not going to pay tax on the interest on government security. Another way company can avoid tax, claiming of excessive interest on loan. Company can give their multinational, their subsidiary, a loan that their subsidiary will pay interest on the loan. That interest paid by the subsidiary will reduce the company tax liability. So these are the way or method by which company practice tax avoidance. What are the methods by which company practice tax evasion? What are the methods or way in which company engage in tax evasion? What are the ways in which company engage in tax evasion? Number 1, failure to register with relevant tax authority. Refusing to register with relevant tax authority. When you are a company, you fail to register for tax so that tax authority will give you tax identification number. You do not go and approach them that you want to register for tax. So failure to register for tax is a method of tax evasion. Another one, failure to file tax return. At the end of the year, you fail to file tax return even after you have registered for tax. The method of tax evasion. Another one, filing of incorrect tax return or understating your income. When you file incorrect tax return or you understate your income, it's a method of tax evasion. Another one, overstating expenses. You overstate your expenses in order to reduce your total profit so that your tax liability will be reduced. It's a method of tax evasion. Another one, engage in artificial transaction. You enter into artificial transaction that is not done as arm's length. So it is a method of tax evasion. All these are the methods by which company practice tax evasion. All these are the methods by which company practice tax evasion. The next thing we need to look at is what are the measures put in place by government to curb tax evasion? What are the measures put in place by government to curb tax evasion? What are the measures put in place by government to curb tax evasion? What are the measures put in place by government to curb tax evasion? Number one, issuance of tax clearance to company. If a company want to bid for government contract, government will say go and provide your tax clearance. If a company want to obtain loan, they will say go and provide your tax clearance if they want to obtain loan from bank. And tax authority cannot give you a tax clearance without you paying the appropriate tax. That means tax clearance means they have cleared you that you are a responsible taxpayer. So issuance of tax clearance certificate is one of the measures that which government use to curb tax evasion. By giving tax clearance certificate to company, it will encourage some company to be paying tax. They know that if they want to bid for government contract, they will ask for tax clearance certificate for them. That will warrant them to go and pay tax. Another one, stipulated penalty. Government need to introduce penalties or punishment for going against the tax law. Introduction of stipulated penalties or punishment for going against tax law. Government need to punish those who evade tax so that it's going to serve as a deterrent to others. It's going to serve as a deterrent to others. So, introduction of stipulated penalties for going against tax law. Another way government can curb tax evasion is withholding tax deduction on some transaction. Government should be deducting withholding tax on some transaction. That will avoid tax evasion. If you receive an income, the payer of that income deduct withholding tax and go and remit the withholding tax to government. That is going to avoid tax evasion. So withholding tax deduction on some transaction is one of the methods to curb tax evasion. Another one, tax education. We need to educate taxpayer the importance of paying tax. Why taxpayer need to pay tax? What are the benefits of tax collection? We need to educate taxpayer. So withholding tax education. Another one, tax audit and investigation. At the end of the year, one of the ways to curb tax evasion is tax authority should be going to taxpayer office to go and be reviewing or examine their record to know that whether they pay the appropriate tax or not. If they discover that they did not pay the appropriate tax, they should ask them to pay the additional assessment and they should pay penalties on it. So tax audit and investigation is going to curb or minimize tax evasion. Another one, introduction of TIN number. Introduction of tax identification number for open of bank account. Tax authority should mandate bank that if a bank want to open corporate bank account to any company, they should ask them for TIN number. By doing that, that one will minimize tax evasion, or is going to curb tax evasion. Another one is automated tax collection by using IT to collect tax, by ensuring that every taxpayer is automated. They are now on a automated tax system. With that, we can track the transaction online. So that will reduce tax evasion. It's one of the way to reduce tax evasion too. Introduction of tax incentive too. Granting of tax incentive to those who are paying tax regularly is going to serve as a means of reducing tax evasion. Those who are not paying tax, that one will motivate them to be paying tax.
It's cold now. The floor is cold.
So, introduction of tax incentive. We also curb tax evasion. What are the measures put in place by government to curb tax avoidance? Measure put in place by government to curb tax avoidance. Number one measure put in place by government to curb tax avoidance is Section 19 of CETA, which is called dividend payment. Number one measure put in place by government to curb tax avoidance is Section 19 of CETA, which is called dividend payment. When a company paid dividend in a particular year, and that dividend paid by the company is more than the total profit of the company, that means that company is going to be assessed to company income tax based on dividend. That company is going to be assessed to company income tax based on dividend at the rate of 30% of the dividend paid to the shareholder. That means if a company in a particular year, they have a lower profit and they are now paying dividend to shareholder, the dividend that they pay to the shareholder is more than the total profit. If that company want to pay company income tax authority will assess the company to company income tax based on the dividend paid, not on the total profit, since the total profit is less than the dividend paid. And the company income tax is going to be 30% of the dividend paid to the shareholder. So these are one of the measures used by government to curb tax avoidance. Another measure used by government to curb tax avoidance is called arm's length transaction. Section 22 of CETA, arm's length transactions. If there is an artificial transaction between two related parties, government tax authority will ensure that that transaction is done as arm's length. They will determine the market value of that transaction and they will use the market value to assess the company to tax. Another way to curb tax avoidance, method used by tax authority to curb tax avoidance, another way to curb tax avoidance is turnover assessment. That one is Section 30 of CETA, turnover assessment. Section 30 of CETA, turnover assessment. Section 30 of CETA, turnover assessment. When a company does not have accessible profit or adjusted profit, but the company has a turnover, that company is going to be assessed to tax on turnover. Fair and reasonable percentage of the turnover is going to be used to assess the company to tax. So that is one of the way to curb, because some company in the past, they will say since they don't have accessible profit or adjusted profit, they will not pay tax, but they have turnover. When they have turnover, they are going to assess them to tax based on fair and reasonable turnover of the company. So we have another method of by which we can use to curb tax evasion, tax avoidance. Transfer pricing regulation. We need to regulate transfer pricing between two interrelated parties. This is another method that can be used to curb tax avoidance. Transfer pricing regulation. Transfer pricing regulations too is a method by which tax authority use to curb tax avoidance. Apart from all these methods I mentioned above, we have another method that we can use to curb tax avoidance. Restriction of capital allowance claim. Restriction of what? Capital allowance claim is another method that we can use to curb tax avoidance. We need to restrict the capital allowance claim. If a company have too much of capital allowance, what percentage are we going to reduce it to? What percentage are we going to restrict it to? Two-thirds of accessible profit or adjusted profit is one of the ways that government use to curb tax avoidance. Some companies, they will be buying qualified capital expenditure to claim enough capital, to claim too much of capital allowance to reduce their taxable profit. Tax authority now said if we have too much of capital allowance, we need to restrict your capital allowance to two-thirds of your adjusted profit or accessible profit. Is one of the methods used to curb tax avoidance. Somebody asks, raise hand, what is your question? What is your question? So, restriction of capital allowance claiming is a method used to curb tax avoidance. Payment of minimum tax too. Payment of minimum tax is also another method government use to curb tax avoidance. Even if you make a loss in a particular year, you make a loss, you must pay minimum tax. Payment of minimum tax is also another method government use to curb tax avoidance. All these are the methods government used to curb tax avoidance. So, ladies and gentlemen, this is what we have on tax evasion and avoidance. So we're supposed to solve a question under this material, but because of time and I have another lectures, this is almost 12:36. This is where we stop. We are going to continue by solving questions under this tax avoidance and tax evasion. That question is very important. Though the solution is there, but it's an important question. We need to solve it. So we are going to continue from where we stop. This third topic, tax haven, we cannot continue today because of limited time we have. I'm having another lecture by 1 p.m. So I need to rest. So this is where we can stop. So this is what we have so far on tax evasion and avoidance. In tax evasion and avoidance, we discuss what is tax evasion, what is tax avoidance, what are the reasons why people engage in tax evasion and avoidance, what are the methods used by government to curb tax evasion, what are the methods used by government to curb tax avoidance, what are the methods in which taxpayers use to practice tax avoidance, what are the methods in which taxpayers use to practice tax evasion. We have said that so far, and we try to distinguish between tax evasion and tax avoidance. So please, let's take note of all the silent points in this material. Let's try to summarize this material in our notes. So this is what we have so far for today. Because of time, this is where we stop. Do we have any question? Any query? Do you have any question?
Hello, sir.
Okay.
So when is the next lecture?
Are you an online student?
Yes.
So our next lecture will be on Sunday, next week Sunday. But I'm thinking for me to solve this question on tax evasion and avoidance, if tomorrow in the evening, if we have time, I'm going to do a combined class again so that we can solve. There's a particular question I need to solve on this tax evasion and avoidance material. That question is very important. It's a calculation question. So I need to solve it. So by tomorrow on Saturday, in the evening, we may fix a lecture, maybe from 7 p.m. to 8:30 p.m. I will discuss with admin. If that period is not occupied, we fix a lecture to finish solving this question on tax evasion and avoidance. And we are going to discuss tax haven. Tax haven is not much. It's one of the international tax policy. We are going to discuss that tomorrow, if time permits. So, if time permits us. So that by next week, Sunday, we are moving to another area. So, and it's likely this month, that is when we are going to end our lecture. We cannot extend our lecture to May. We must end our lecture by this month. So we are ending our lecture finally end of this month. Let's try to take note of that. So we have done so far